Why are technology stocks collapsing? Today we're going to unpack this question, consider some of the key drivers, and then talk about where things might head from here. Markets are currently scared. The Nasdaq has once again entered into a bear market, selling off by 4% in just one single session. As we know, we're in the midst of earnings season right now, and earnings season is critical. We've just seen Microsoft and Alphabet report, and up ahead at the back end of this week, we've got Apple, Amazon, and Meta, in what will be quite a significant week for the broader market. As we know, many of these mega cap technology names make up a significant weighting on the S&P 500, and as a result of that, they do have the ability to set the trajectory and move markets depending on the results and the market's perception around these. It's a very interesting discussion. As we know, the markets at the moment, there's negative sentiment surrounding it. Just to paint that picture, the S&P 500 as a proxy for global markets has put in over 15 year-to-date lows, and we're only in the back end of April. At the moment, we're in a market where we're seeing rallies being faded and sold into. There's negative sentiment surrounding it all. And of course, I'm sure you'd be familiar with the fact that we're seeing a divergence and a bifurcation of the markets at the moment, with technology, which has been a real market leader over the past decade, underperforming, dating back to November where the correction began. But for many of these unprofitable and early stage tech names, really the rot started in a lot earlier to that. So the question then is, why is this happening and what does it all mean? I think first and foremost, one of the key drivers that many of us are familiar with, but it's worth, of course, wrapping back up and discussing, is inflation and the Federal Reserve. We know that central banks around the world have put inflation at the top of the list. This is their key mandate and focus at the moment. Inflation, of course, has been more persistent than was initially anticipated. That word transitory has been well and truly retired. We know with the Ukrainian and European situation playing out, the supply chain bottlenecks and the difficulties that continue to evolve and pop up in supply chains around the world mean that inflation is, of course, going to be more difficult and something that will continue to be navigated moving forward. The market is wondering, when will inflation begin to subside, at what level and at what velocity? And of course, we know that the central banks, one of their key tools to fight inflation is interest rates. And the standard discussion goes, as interest rates rise, of course, discount rates rise with them. As a result of that, the present value of future cash flows is brought down. And as a result of that, companies that have got long duration valuations, particularly many of these at the more growthy end of the market, of which a lot of these are technology-based names, are going to be the most exposed to this. With central banks potentially having to raise rates faster, this is why there's a lot of uncertainty in not only the technology names, but a lot of the growthier end of the market at the moment. Along with that as well, really feeding into that is the valuations discussion. It's not going to surprise anyone that over the past couple of years, valuations have become stretched in some cohorts of the market. As we know, there's been a significant valuation expansion over this past period. As we can see here, the S&P 500 PE ratio is starting to trend downwards from its peaks, but it's still sitting at around 21. It's above 20. We know that this is still a far cry away from the long run average, which is a lot closer to 15. There is a mean reversion that we're starting to see pick up pace, but the question is, how will this mean reversion play out? Of course, as we know, the growthier end of the market has been where a lot of the speculation has been. It's seen a much more significant mean reversion with many technology names down 30, 40, 50, in some cases 60, 70 or 80% down from their all-time highs that were set in 2021. And as we all know, the unprofitable technology cohort has been hit some of the hardest because, of course, they've got a lot of future growth priced in, future cash flows priced into it as well. And that was where a lot of the stretch valuations were seen too. But another driver that's fascinating to reflect on as well is the supply and demand discussion. As we know, there are a few exogenous factors that have fed into the supply and demand, not only in the technology sector, but for the broader market. But the tech sector has not been immune to that. On the supply side, it's the supply chain difficulties that we've seen. Of course, potentially for hardware, whether it be for the semiconductor shortage that we've seen play out, whether it's for parts that companies are having more difficulties getting. Is there delays, there's issues with logistics, or potentially rising input costs as a result of that, which of course have hit many sectors of the market, but technology is one that's definitely been hit by that as well. And then on the demand side too, we know that many of these technology names were pandemic winners. I'm sure you can just rattle through the lists in your mind about many of these pandemic winners in 2020 and the better part of 2021. However, many of these companies have had some difficulties over this past period. If we think about the software-focused businesses, demand in many of these cases is starting to normalize back to pre-pandemic levels. Or even if it hasn't normalized, a lot of these companies have got really difficult comps to make, where we're looking at the year-on-year, 12-monthly comps that we're starting to cycle through now. Even good results are being compared against great or exceptional results, and that's difficult for a lot of companies as a hurdle to overcome, particularly where a lot of these names are priced to perfection, or at least were previously priced to a very high bar to overcome. And then as well on the demand side, interestingly, we've started to see some insights from advertising businesses like Snap. We had Alphabet overnight as well. Meta is not too far away in the next couple of days as well. And a lot of these have provided some insights about the strength of potentially the consumer with the proxy of advertising demand for that. We saw that Snapchat had a really interesting report. They missed on both the top and the bottom line. However, their users actually grew ahead of consensus. So that's an indication that it's not a user issue, but what it actually is the demand from advertisers who potentially may not need to advertise as much for all of the reasons that we've outlined above, whether it's the supply chain bottlenecks, rising inflation, interest rates, all of these different factors. So it's a fascinating discussion. Of course, we don't have the answers in the here and now. I would be keen to know your thoughts, so drop in a comment below what you think about the current state of things. But as we know, we don't have all the answers, but the market will look to a few key catalysts up ahead as an indication about where things might head. First and foremost, the Federal Reserve, they have a key FOMC meeting in the earlier part of May. The market's now anticipating and pricing in a 50 basis point rise. Jerome Powell opened up the door for that 50 basis point rise and said they would do what was necessary to tame inflation. And this will be following suit from other central banks around the world. Bank of Canada, RBNZ, a couple of the names that have raised with a 50 basis point rise. And so it'll be fascinating to see what the Fed does and the market reaction to that. As we mentioned, earnings season, we're right in the midst of it now. Apple, Amazon, Twitter, Meta, PayPal, a couple of names that are still due to report over the next few days. Around a third of the S&P 500 are reporting in this week alone. So a lot of these names have the ability to move markets contingent on what those reports are. And it's also worth noting as well that not all technology is made equal. Of course, at the moment, we've seen a rising tide lift all ships, and as we've seen the growthier end of the market sell off, a lot of these names have been grouped in together. But there is a difference between some of these mega cap technology names that are cash generative, have got significant balance sheets, in comparison to, say, an earlier stage technology name that's unprofitable and has got a lot of future growth priced into it. And so it'll be fascinating to see if we begin to see a broader divergence between some of these names moving forward. At the end of the day, the underlying discussion is sentiment has changed for the technology sector. The market moves through cycles. We're starting to see a more cyclical tilt. And of course, technology has been a big beneficiary and a winner, not only over the past few years, but really over the past decade. It will be interesting to see how things play out from here. Sometimes you see really average pieces of news or not much news at all, seeing some strength in it in terms of market response. And other times you see difficult periods on markets where even great reports or really solid pieces of news not really getting a bit of attention. It will be interesting to see if we start to see sentiment shift, but at the moment it's fairly clear that sentiment is in a downward cycle for a lot of this broader technology sector. If you're interested in some more broader macroeconomic discussions, here's a video that you can check out after this one. A big thank you for joining us. For now, stay well and happy investing.